Hello everybody, Carl Keister here with ClearSurf Financial Education. Today I thought I would bring a video about the potential tax code changes coming under President-elect Joe Biden's plan. So these plans were laid out earlier in the year. This is the latest version that I have found is dated October. But a lot of this is going to be obviously up to change depending if the Senate is controlled by the Democrats or the Republicans come January. But this will give you an idea. They do want to raise taxes. He had mentioned that, and he said he was only going to raise taxes on those making the higher tax bracket, up or over $400,000. So let's just go through a number here. There's 12 pages of changes, but I'm going to touch on what I think is going to be probably the top 10, and that will affect some of you. The latter ones, 7 through 10, probably more than likely. So let's start off with the first one here, which is they want to impose a 12.4% tax on Social Security wages on those making more than $400,000 a year. So there's going to be a donut hole, and that means that if you make more than $137,700, you don't have to pay this additional tax. And then up to $400,000. Over $400,000, you'll have this new tax, which is 12.4%. Half that'll be paid by the employer, and half that paid by the employee. So that's a little bit different. That's something that they're trying to show there. And also, they want to revert the top tax bracket, which right now is 37%, and that's going to go back to 39.6, which is what it was prior to President Trump getting in office and passing the Tax Cut and Jobs Act. So over 400,000 is going to go back to 39.6. So that's two of the biggest changes. The number 3 is going to be the capital gains tax. So taxes on long-term capital gains or qualified dividends, they're treated as ordinary income, and that would be 39.6%. Currently, those are being taxed at 20% plus a 3.8% surcharge tax. So you're talking about a double. You're still going from 20% to 30.6 on people making over $1 million. That long-term tax is going to start being taxed. So I know a lot of people are thinking, wow, sorry, woe is me if you've got to pay tax. If you've got over $1 million of income, above $1 million income, you're going to be paying 40% basically instead of 20. I get it, but it might make some investment decisions for some people out there that may not hold those investments. They may want to dump those investments and lock in paying tax a much lower number now. So looking at phasing out itemized deductions. Now this has already been done under Tax Cuts and Jobs Act. There's already limitations in there now, but it sounds like that over 400,000 is the target again, where you're going to have limited itemized deductions. We're also looking at phasing out qualified business income deduction, which is section 199A, and that again will be for income above $400,000. So a lot of things dealing with income above $400,000, I get it, a lot of people might not be affected by that. Now we're going to get into the meat and potatoes of it. So they do also want to expand earned income credit for childless workers age 65 and older. And also there's going to be some renewable energy credits in there as well. So that earned income credit, that just means that people that are over 65 that have on a lower income spectrum might get earned income credit. Obviously, if they have no dependent children at home, that's going to help them out. Now, the big one I see is going to be dependent care credit. Dependent care and child credit actually is what it's called. Last year, it was $3,000 per child is the maximum you could claim. This year, they want to take that, if it passes, of course, they want to take that to $8,000 per child. So you could claim up to 2 children, up to $16,000. So last year, 2 children, maximum credit you could get for dependent care expenses was $6,000. Now they're looking at $16,000, and they're raising the reimbursement rate from 35% to 50%. So that's huge. That's more than a double for those folks who have children that got the credit last year. And then those that have children, they're looking at taking the tax credit higher as well. Last year was $2,000 per child under Joe Biden's plan. He's talking about raising that to $3,000 per child age 17 and younger. And then an additional $600 bonus for children under age 6. So last year that was a $2,000 credit. Now this year it could be a $3,000 credit with an additional $600 bonus for children under age 6. So that's pretty big. And then also number 9 and number 10 here. Actually, I think I skipped one of them because it's not one of most people are going to be affected by. So this is going to be bringing back the first-time homebuyers credit. So if you remember during the financial crisis, they had a $7,500 first-time homebuyers credit that you had to pay back $500 a year over the next 15 years when you file your tax return. And I think there was a brief period the following year they did $8,000 first-time homebuyers that you did not have to pay back. So this one will be $15,000 first-time homebuyers credit if they get what they want. So that's pretty big. That definitely will be a boost for people looking to buy a home. That's a heck of an incentive, especially if it doesn't give you all the details right now, but $15,000 is a lot of credit. That's a lot of money. And then the other thing I want to point out too is they want to expand the estate and gift tax by restoring the rate and the exemptions from 2009. Well, that's going to be significant because I didn't pull up exactly 2009, but there was a point in time it was close to 2 or 3 million, and that just kept doubling. Last year was like 11.5 million. So if they roll that back, that could actually hurt some people that have held property, family businesses, farms, things that have been around for a while. When they go to sell them, that could definitely impact. Okay, so that is some of the biggest things out there on the individual side. And then on the business side, corporate tax under the Trump, when he pushed through the Tax Cut and Jobs Act, they took the corporate tax rate from 35% down to 21%. So Joe Biden's talking about moving that back to 28%. And so why that's important is whenever companies, under the last few years, the Obama administration, companies were moving overseas to places like Ireland and some other countries because they had a 20% corporate rate. So if the jobs go over there, less jobs here. So Trump put an end to that and brought the corporate tax rate down to 21, really disincentivizing anybody from taking companies overseas. So this going from 21 to 28, will that push companies to go back overseas again? I don't know. If it does, that's obviously a negative, less jobs in the States. So we'll see about that. So that's really the biggest ones I see. There are tons of other small tax credits for small businesses that want to adopt a retirement plan, energy credits, vehicle credits. There's also some credits in here that are discussing the surtax. They call it a 10% surtax on corporations that offshore manufacturing and service jobs and then bring those products back to the States. So I know when Biden was running for office, he had mentioned about bringing back PPE production, bringing it back to the States, not just for national defense, but also for making sure we don't run out like we had some problems during the last go around with the virus. So we'll see what happens this fall, but just trying to create more jobs in the country. So that is just summing up this. This is not all inclusive. This is the Tax Foundation report that I found, and it's 12 pages long, goes into a tremendous number of these. But these, just wanted to let you know, there will be some changes coming down the pike here. Looks like Biden's going to get in. A lot of the 4 lawsuits against the remaining states were dropped today, I saw. So there's a really good chance that Biden's going to be our next president. And he ran on raising taxes on the higher income folks. And I did go through, I saw on this document, how they're raising the funds. They're talking about over 10 years, this is going to raise about $3 trillion. And that estimate came initially at 3.3, and then because of COVID, they brought it down to 2.8. And so I'm just going to round it off and say, let's figure, supposedly it's going to raise $3 trillion over the next 10 years. So as that higher payroll, Social Security tax, I should call it, on higher wages kicks in, that's going to raise almost $820 billion over 10 years, raising that ordinary income bracket up almost 2.6%. That's going to raise another $148 billion according to the Tax Foundation. And then capital gains on over $1 million in income, that's going to raise $470 billion over 4 years. But then the credits give back almost $200 million on the child credit and the expanded credits for daycare, so child dependent care. So it'll be interesting to see what goes through. But remember, January, we're going to find out if Republicans keep the Senate. If they do, like anything else, this plan will be changed. There'll be negotiations on both sides, and the final outcome of this we won't know until they get done negotiating this thing. And so it does look like higher taxes are coming. Hopefully, like he said, it's only going to be for those making $400,000 or more, because that's going to definitely be not the majority of the country. That's a very small fraction that make that over $400,000 a year. But I do think that's going to be coming down the pipe here. So anyway, just wanted to bring the update to you. This isn't, cut and dry. This is not that simple. And but I just want to give you an idea of what could be coming. So there could be some things in there, but we'll have to see. So until next time, please give me a like, and also if you like the information, so I can keep bringing this information to you, and let me know if there's anything else that you want me to look into, what topics that may be of interest to you. So comment down below. Thanks.